In today's video, I'm going to show you how I use $250,000 in margin to diversify away from Cornerstone. Cornerstone is by far our largest holding. We have about $400,000 invested in Cornerstone, and it pays about 80 grand per year in dividends, about 7,000 per month. So it's a large contributor to our over 100,000 a year in dividends that we make. And it's important to understand that while you want to have all of your investments tied to the indexes, which Cornerstone is, it's the S&P and the NASDAQ, you still want to diversify away to protect yourself. And I have 3 reasons why I diversify away, and I'll show you that in 1 second. First, I want to show you we're up for the year 17%. The Dow's up 0.46, the S&P is up 7, and the NASDAQ's up 17%. So we're right in line with the markets. We're beating most of the indices, and again, we're doing that because of Cornerstone. The first reason why I diversify away from the C's is simply to eliminate concentration risk. Obviously, you don't want to have all of your eggs in one basket. And, they say never to put even more than 20% of your funds in one name. Okay, so you don't want to have more than 20% in one name. Cornerstone, we have 400,000 in. Why do I do that? Because it is the index. It is the S&P and NASDAQ. So I don't mind having all my money in it. I just don't want the company to default. I have the same fear for any of these other companies, yield max funds, any of these other funds. I simply don't want too much concentration risk in one fund that can take me down, especially when using margin, which is this 250,000 number here that you see below, 249,000. So when you're in margin, you don't want to have any holding default on you. That can spell disaster. So you have to diversify away. So that's why I'm using this purchasing power of 552,000 to buy these other names that should protect me in case Cornerstone goes default. I don't think Cornerstone will default. I keep telling everyone this. It's a 4-star fund. It's been around for decades. I'm just simply protecting myself because I'm in margin. Even if I wasn't in margin, I would still protect myself like this. So this is what I'm doing with Cornerstone. I'm not putting all my eggs in one basket. I'm starting to diversify away with this 250,000 in margin. The second reason why I diversify away from Cornerstone is for daily performance. Cornerstone will do well over the year if you play it right. Please see my past videos on Cornerstone. Again, if you want to learn how to play the rights offering correctly, or purchase one of my e-guides if you have more questions on how to play Cornerstone correctly. But it will not give you daily performance sometimes. As you can see, if you look at my performance today, we're down 1%. Look, we were down 0.57% today when the market was up 0.3 and the NASDAQ was up 0.6. Usually, if you see my videos, I'm usually beating the market, and Cornerstone usually does a great job of beating the market for me on typical market days. However, sometimes after around the X dates and around the rights offering times, Cornerstone can lag and move sideways to down and erode, and just like a lot of these funds can. And that's what one of my subscribers' portfolio shows is, he has a lot of good names, a lot of the same names that I own, okay? Especially names like, I have them written down here. I don't want to show you his portfolio directly, but he has holdings like AGNC, UON, which is UAN, JEPI, SVOL, QYLD, XYLD, ARR, TLTW, HYIN, even the Teslas and the Clips of the world. He has those. And so all of those move sideways to slightly up, but mostly down, okay? Even Cornerstone, for me, if you look at a chart of Cornerstone, you'll see that it moves down over time. And that's what a lot of these closed-end funds do. That's the problem with them. And people think, why would you be in them in the first place? Because the dividends cash flow the funds. If you hold the dividends long enough, in this case Cornerstone, for 5 years approximately, if you hold this fund, you cash flow your investment at a 20% dividend. Times 5, that's 100%. And obviously Cornerstone does the drip, where you get your profits reinvested at the NAV, not the market price. Again, see my past videos on that if you're interested, but I can show you this right here. Cornerstone drip. We go to the beginning. Usually it's at the beginning of the month, and my dividends are 3,500, and so these are the instant profits that you get. So 15% gain here on this 3,500 invested, 15%, because they buy it at $6 for you, which is way below the market price of as you can see above 7. So 771 is the last price here, and they buy it for you at 6, around 6, where the NAV is. So that's the beauty of these vehicles. A lot of them do special drip programs, but Cornerstone is by far the best to me. So my subscriber, again, has these funds that decay, just like I have. Many of these funds decay, as you can see in here. RYLD, even GOF, OR, because covered call funds have their upside cap, so they'll decay. A lot of these funds with return of capital aspects, like Cornerstone, will decay. The way to offset this problem is to buy upward, left to right moving funds and stocks. So funds like a USA, if we go into USA right here, and I have some names, if you stick around, keep listening, I have a list of a few names that move upward, left to right. USA, as you can see on a full time frame, yes, it had a problem during 08 like many funds did, but it started moving upward, left to right on its chart over time. And it has a 10% dividend. If you just saw there, I'll go back. But USA, 10% dividend. Again, moves upward, left to right here. From 2008, it's been on a steady climb upwards. And that's what you want when you have dividends of, let's say, 10% that it offers. Like you just saw, it moved, and we've had a terrible bear market, but look at over the last 2 years, but look at what it did over the last 5 years. You can see how it's moved from, it was a good mover, from 5 to 10 almost. It moved from 2020 to 2021, from some 6 to 9 there, 6 to 9. Okay, so this is what you want to see when you are in dividend names. You want the best of both worlds. You want them going sideways to up, collecting these dividends, 10% dividends in the process. You want them to preferably move upward, left to right on their chart, not just sideways. So 10% dividend for USA. It's one of my favorites. That's why it's near the top in my holdings here. I have over 15K in it in USA because again, it moves upward, left to right. So do these other funds. I can list a few here. Slow down the video if you need to remember, if you need me to repeat these names again. But USA, STK, ASG, EOS, BST, and even Schwab D, SEHD, yes, and Devo, which we have videos on, but I don't really like Schwab D and Devo as much because they don't provide qualifying income to the banks. They don't provide much. They have small dividends. And they do stabilize your portfolio, and this is why you need them. They have many defensive names in there, but they have small dividends, so they don't contribute qualifying income to banks. You can't live financially free off Schwab D or Devo, again, because the banks don't take stock market gains. They take only dividends or a paycheck. So that was my revelation. And that's why I started the channel, by the way, is because everyone else has channels on investing and trading, but that can't get you anywhere. First of all, 90% of traders lose over time, but also, again, even if you won, the banks won't take it. You can't have a house. You can't qualify for anything with stock trader money. I tried it when I had my child. They would not take my house. They wouldn't take my stock market money off of UPRO. So I had to switch to dividends. He said he needed 50K and qualifying income over 2 years average, so for a $300,000 house. So that's what I had to do. I had to get my dividends up to 50K. And I used margin to do this, the 250K, but I diversified away from Cornerstone because, you never know what can happen with one company. So I diversify away, again, for 3 reasons. It's not just for concentration risk, that's one, but it's also to increase daily performance, okay? And that's very important because daily performance, not only does it help you have better performance, but it takes away risks of margin calls. If you're doing better, then even when the market falls, you have a cushion there because you've been performing so well. You don't want investments that just go into the ground forever. Like a Cornerstone, you have to play it right. But let's just say an ARR, which was a good stock that, it has a high dividend, which was a good candidate in anyone's passive income portfolio. ARR, again, if I can get this in quickly here, ARR, Armor Residential, it has a 19% dividend, but as you can see on the chart, it just goes downward basically over time. And this is still fine. You're going to cash flow your investment over time, but as it's moving down, so is your market value, and this can put you in a margin call if you have too much margin on. So you have to be aware of these downward sloping charts as you play with margin. And without margin, you have to But when you're in margin, you especially have to watch out for this fact. So I gave you some upward moving left to right stocks like USA, STK, ASG, EOS, BST, Schwab D, Devo. I even have some of these bond funds that move upward left to right a little bit, like PTY. CSQ moves upward left to right. It's 4-star fund. Shy does, if you look at its chart. So all these are designed to offset the sideways decay and Cornerstone, and help eliminate default risk in Cornerstone. So I don't want default risk. I don't want concentration risk, which I don't know if you guys know, but if you put all of your stocks in one name in margin, when in margin, they increase the maintenance of those names, and that hurts your available withdrawal. So you can't have concentration risk. You can't have too much of your portfolio in one name. So I split them into Cornerstone and all these other names. I do it for diversification, for performance, and then I do it to eliminate margin calls, most importantly, over time. So I hope that this video helps. Let me know if you have any other funds that move upward, left, or right and can offset margin call risk and increase performance. And if you need any reviewing of your portfolios, please let me know. The names that I listed to you from my subscribers' portfolio are just fine. You just need to sprinkle in some upward, leftward moving stocks and funds that can help offset that lagging performance from those other passive income names. So again, hope this helps. Leave comments in the section below if you have any more questions, and I'll talk to you soon. Thanks.